Drodzy Państwo, przed nami gość po raz pierwszy, i też prosimy tych, żeby Państwo już się skupili, kawa może być konsumowana, ale już zaczynamy kolejną część. Drodzy Państwo, jeszcze raz zacznę, z nami gość, który pojawił się na konferencji rynku kapitałowego w Bukowinie już wcześniej, pojawił się już kiedyś. Można powiedzieć, że jego udział w konferencji był jedną z korzyści, jaką konferencji przyniósł COVID i lockdowny, bo wtedy konferencja rynku kapitałowego odkryła technologię w szerszym zakresie i zdecydowała się na to, żeby przeprowadzić jedną z edycji, jak Państwo pamiętają, w sposób zdalny. I wtedy ów gość był z nami. Na co dzień obserwuje globalny rynek długu, ale nie tylko, to co dzieje się w gospodarce. I dzisiaj o tym globalnym rynku opowie i jego implikacjach lokalnych. Ladies and gentlemen, it's my great pleasure to introduce our next guest, Colin Ellis, Global Credit Strategist, Moody's. The floor is yours.
Thank you. Thank you very much, everybody. It's truly wonderful to actually be here today in Bukovina in person. I was delighted to be able to help during COVID online, but it's just not quite the same thing. I apologize firstly because my Polish is non-existent, so I'm going to talk in English. And secondly, of course, we're running a little bit behind schedule. I've got to be honest, I'm British, so we're very used to that because we're still waiting for some Brexit benefits to arrive. Some of you might feel it a little bit differently. But what I'm going to do today is I'm going to try and talk for about 20 minutes or so, maybe a bit longer, on how we see the global trends affecting the macroeconomy, but also, of course, credit, because we're a credit rating agency, that's where I work. We'll try and allow a little bit of time for questions at the end, and I will say it up front right now. If you like any of the slides that I'm going to use, please don't scribble them down. You can take photos if you want, but if any of you want a copy of this deck, you can just email me at the email address on the screen right there. It's my first name, last name, @moodys.com, and I'll be very happy to share it with you. So, to dive in, I think coming into 2023, we really saw this as a year, not so much of recovery, but probably a year in which the big impact of some of the shocks we'd seen in the past was finally going to start fading. So we know that COVID disrupted the global economy to a massive extent. We also know that sadly the ongoing war in Ukraine, very close to here, shows no signs of really moving in one direction or the other. But the thing about economies and the thing about credit is when a shock happens, we know that either the real economy responds or the nominal economy responds with inflation or some combination of both. And this was the year where we thought those two big shocks coming out of COVID, trying to deal with the aftermath of the start of the conflict in Ukraine, I have no expertise on how it will end. This would be the year where we saw those really bite in terms of the macroeconomic data. So what I'm going to do is I'm going to take you through our latest forecast to start with, and then dive a little bit into how we see things in Poland in particular. There is a very big health warning with these numbers that I'm about to show you, because we are literally this week in the process of updating all of our growth and inflation forecasts. We do those 4 times a year normally for the majority of economies, but we rate over 120 sovereigns, so it takes time. So that's all a means of a kind of reassurance, because the Polish growth number here for 2023 is going to be revised up. We're not going to see a kind of modest decline that you see here. So ignore the numbers and think about the shapes. This is really the year where we think high inflation bites in terms of real activity, where consumers start to pull in their horns more. This is really the year where we expect investment to probably reach its nadir as well. And then the story into 2024 isn't one of robust growth with all the bars jumping back up massively, as much as a further bounce or recovery from what we've just been through now. Now, it's fair to say 3 months ago when we were doing our forecasts, we thought things would be much worse. And the European economy and the global economy has definitely come through the latest rounds of shocks more strongly than we expected. Unfortunately, some of that is down to the weather. And I don't know about you, but when you're making investments and capital decisions, using luck as your guiding force is rarely the best idea. So we know that there are further challenges lying ahead for Europe in particular, with next winter's season coming. But the progress that has been made, particularly around issues like LNG in Germany and alternative supply, has been faster than we expect. And that speaks to more resilience in the region than we would have thought otherwise. It's still not a strong recovery story, but things do look a bit brighter than we thought. One reason for that is, while interest rates have been going up, there's more to the financial side of the economy than just policy rates with what central banks do. I know that the Polish Central Bank, the Monetary Policy Council, held its main policy rate at 6.75% last month here. We still expect a bit more monetary tightening, particularly in the US and in the euro area. But the interesting thing is, if you look more broadly at financial conditions, if you look at yields and equities and credit conditions, we actually turned the corner. You can see the uptick towards the end of the chart here a little while ago. These are our proprietary, these are data Moody's creates, our proprietary financial conditions indices, and they look at more than just monetary policy rates. So things are already easing a bit, and that should help support the real economy, at least. With inflation, these are our inflation forecasts, again, in the process of being updated. The important thing here is, whereas the growth chart was all about growth over the year as a whole, these are showing you our forecast inflation rates in December. So what's the 12-month inflation rate at the end of the year? And we are expecting inflation to get back to single digits in Poland over the course of this year, and then to fall further into 2024. But there are some very big risks here in terms of how this plays out. We know that for most countries in the world, the energy shock, and to some extent the COVID shock, is a negative supply shock. If you are reshoring, if you're restructuring your supply chain, if you're coping with higher energy prices and finding alternative sources, that has to weigh on productivity in the long run. And that means lower real wages. But how you get there matters. You can get there through people accepting inflation being a bit higher than earnings growth for a while, or you can get there because people unfortunately lose their job, and that pushes down on real wages. So far, we are very much in the first camp, but real wage resistance, stronger earnings growth, would definitely put that at risk. So that's our kind of top-down macro view. One point I wanted to make, and this is key to the work we do at Moody's, we don't just look at kind of macroeconomics, we investigate individual companies as well. And inflation isn't actually necessarily bad for everybody. Because for companies, it gives you a chance to put prices up. And that's particularly relevant for those companies that don't have pricing power in normal times. They find it difficult to raise their prices. So what I'm doing here, this is from a piece we published last year, we're looking at the distribution of pricing power in some major European economies. There's a footnote which basically says ignore the dark blue bit, because it's not very representative. But you can see that across Europe, we've got some companies where the profit to revenue ratio, a simple measure of pricing power, is more than 40%. It's a hell of a profit margin. But there are lots of others where it's down near 10%, 20%. And so generalized inflation may actually help some of those weaker companies or these companies with less pricing power, because it lets them pass on costs a little bit more easily. That's not to say that the news has been positive, because it hasn't. These are our rating actions for European corporates on a quarterly basis over the past few years. And you can see that we've taken many more downgrades during 2022 than upgrades. The red bars are a lot bigger than the blue bars. Now, it's not COVID. You can see the spikes there were much more skewed to the downside. But we have been reflecting this weaker macroeconomic environment, these more challenging conditions in our ratings for some time. And I think, unfortunately, it's going to continue. So we rate thousands of companies right the way around the world. And our whole selling point is that a rating should be the same thing, or mean broadly the same thing, whether you're a bank in the Philippines, or a corporate in Brazil, or a sovereign in Africa, frankly. The way we try and tell you about the risks is to show you our sector outlooks, which is what I'm showing you here. And it's very intuitive. Red is bad, green is good. So you can see that we've seen an increase in risks, an increase in the difficulties facing some of the sectors that we rate globally over the past year. But the nice thing so far, at least in 2023, is we don't think it's getting worse. And again, that's consistent with this narrative that maybe we're at the trough in growth, or we soon will be. Maybe we're at the peak in inflation, or we soon will be. And that the rest of this year is just going to be working through that shock. So this is one of our headline indicators that tells us really whether ratings are likely to keep getting downgraded or they might start to stabilize. This is almost impossible to read, I've just noticed, so I apologize for that. But one of the points I wanted to make was we've always said in Europe in particular, this energy shock is going to have a longer lasting impact on a wider range of issuers than the pandemic did. The pandemic was very, very sharp, but actually in an economic context, 2 years is relatively short. The energy shock and the transition away from Russian energy, Russian oil and gas, trying to find new sources, trying to find different ways for high energy intensive industries, seeing the adjustments that need to happen when some of those sectors can't afford the prices that they now have to pay, that's going to take a very, very long time indeed. And what we're doing on this diagram, which I will skip over, but please reach out to me if you'd like it, is talking about the channels where we see the risks. So how we see this flowing through to asset quality for banks, how we see this flowing through to delinquencies for structured finance transactions, and of course how we see it flowing through to companies as well. What does all of this mean? Well, at the end of the day, we're a rating agency, and we're a fundamental credit agency. I'm not in the business of guessing where financial market prices will go, because frankly, if I could do that, I'd be on a desert island somewhere being very rich. Our focus at Moody's is always about fundamental credit risk. It underpins all of the work that we do. And that work ultimately crystallizes as whether companies default or not. So these are our default forecasts globally for non-investment grade companies. I'm showing you all of those issuers rated BA1 or below because we still get very few investment grade defaults. And you can see that the COVID shock, in a credit sense, the hump in the green line in 2020 and 2021 was nowhere near as bad as what we saw in the global financial crisis. And that's unsurprising because we saw a lot more policy response very, very quickly to calm financial markets during COVID. But our forecast is for the speculative grade default rate, this credit default rate where you actually lose money as an investor, to pick up pretty steadily over the next year and then to come back pretty gradually. That's the dark blue line on the chart. But we know the uncertainties here are enormous. We know there are incredible downside risks, not just about how the conflict in Ukraine plays out, but how geopolitical tensions with China unwind, whether real wages take off in the way that I described earlier, and lots of other factors. So every month, we give you alternative forecasts. Those are the dotted lines. And you can take your pick, really. If you think the downturn is going to be much, much worse, then we could be looking at a credit downturn. We could be looking at losses that are bigger than COVID, but not quite in the global financial crisis. If you think it's a meltdown, if you believe the orange line, which is a very severely pessimistic scenario, then we could be looking at something even worse, potentially. But we don't think that's very likely. We're just trying to show you the uncertainties here. And the really good news is in Europe, the picture's a lot better. Because in Europe, we're actually only expecting the default rate to rise from a little bit over 2% at the moment to around 4% and then stay there in about 12 months' time. And 4% is the long-run average here. So the situation in Europe actually looks better than the rest of the world. And because our ratings are heavily skewed towards the US, that's where we have the most ratings, it means that Europe in this credit cycle should outperform the US. And that's something that investors are definitely taking note of. Again, you've got the range of scenarios. We've got some wobbles in the lines that are really to do with the impact of the war and the sanctions that were imposed on Russia. I won't go into those in any detail unless you're seriously interested. But this is a picture of a measured credit deterioration, not a particularly pronounced one. And when I talk to investors about this, they take some comfort from that. Please, sir. So behind these forecasts, every month we do publish sectoral default rates as well. And at the moment, in the US, the default rates are being driven by things like consumer durables and advertising. Here in Europe, I think it's containers and packaging and hotels and gaming. That's where we see the weaknesses. So we do update that in our analysis every month. It's probably worth just talking about what goes into these forecasts, because obviously we have a forecast for macro conditions, and we vary that depending on whether we're positive or negative or in the middle. But the other big ingredient is our rating distribution. You know, we rate over 7,000 corporates, I think, across the broader EMEA region. Every single one of those ratings goes into this forecast. And we use that as a judgment basis for what's going to happen in terms of the likelihood of default. And the fundamental, simple point is the distribution in Europe today is better. Our rating distribution is a little bit better than our US rating distribution. So the sectors will be a little bit different depending on where our ratings are. But it's also true that, on average, the European default rates will be below those across sectors than in the US. Sorry, thank you for the question. I'm very happy to send you the report that this is taken from, if that would be useful. So that's the kind of big picture, and drilling down a little bit into Europe and what we see here. What I wanted to do now is just focus very, very firmly and take a bit of time, really, to talk to you about Poland and how we see the outlook where we all are today. Poland is one of our most stable ratings. It's really one of the countries in Europe that hasn't moved for a very, very long time. And we have an A2 rating, which is not the highest rating in the world, but it's a very solid, very strong investment grade rating. And we have a stable outlook. At the moment, we have negative outlooks in Europe on Italy, Slovakia, and Czechia. And that's partly because of the energy exposure and dependency on Russia. But in Poland, we're pretty confident that things here will be stable. And this is a real selling point when we talk to investors, because investors don't like uncertainty, they don't like volatility. But I wanted to take a little bit of time just to explain to you how we get to this A2 rating. Because sometimes I think credit ratings can be a bit mysterious. We don't do a good job of explaining what we're looking at. And I just wanted to set out how we think about this. Because behind every single one of our ratings, there is an approach or a methodology. All of those are public, but they always incorporate real data, hard data like debt and growth and inflation, but also some judgment calls that we make in terms of how we see things panning out. So for Poland, Poland's obviously a sovereign. It's a sovereign nation. And there are 4 key things we focus on: economic strength, institutions and governance, fiscal strength, and susceptibility to event risk. Here in Poland, the robust, stable economy, which is now very well diversified and is very well placed to benefit from nearshoring as global supply chains get restructured, that's one of the key strengths we see here. The resilience of the Polish economy is something that investors remark upon to me before I've said anything, let alone me trying to talk to them. For all that there are some interesting conversations between Poland and the EU, and I'm a Brit, I'm used to interesting conversations with the EU, we still have a pretty high, strong assessment of Poland's institutions and governance strength as well. A3 is a good assessment for that. We have a few concerns, of course, but they're not particularly prevalent. Fiscal strength as well. We know that SOEs, state-owned enterprises, are an issue here. We know that there are real questions about what would happen if a government-owned entity got into trouble. But starting from a position of debt to GDP between 50 and 60% is normally something we think of as a very good thing. There are plenty of other countries in Europe that would love to have that. So really where Poland is maybe a little bit weaker in terms of the way we think about the rating is event risk. I've got to be totally honest, I don't think there's a lot you can do about that. Because what's driving event risk for us here in a very big way is, of course, geopolitical risk. You have a war next door. And thus far, the response of the Polish economy and the Polish people to support the people of Ukraine has been commendable. But there is simply a risk that the other person involved in this war decides to escalate. Now, that's not something that necessarily constrains ratings in a big way. We have a very good rating for Israel. We have a decent rating for South Korea as well in the AA space. But one of the things the ongoing conflict has made us do is just reassess the likelihood of something going wrong in terms of Russia's relationships with the rest of Europe. You put all this together in the way that's shown on the diagram. You add the first and second, you get something, then you add the third, get something, then you add the fourth. And that gives you this rating range of A1 to A3. And then what literally happens is myself and my colleagues, we sit in a room and we argue about it. In a very polite way normally, but we debate the differences. We debate where the scorecard falls short. We debate all of the things that cannot fit into a methodology. But again, key message is, from our point of view, Poland looks very stable, very attractive to investors. A couple of small points about development, and I think Valdemar touched on this in his opening remarks as well. We do think Poland has untapped potential. This table is taken from a report where we looked at what kind of factors drive domestic capital market development, and in particular, what drives the depth of the bond market. And for us, it's partly about the size of the asset management industry. You have a large concentration of savings here that are just in banks. And it's partly about the quality of the regulation and the regulatory authority. Those seem to be the key factors when we looked across a panel of more than 20 larger, but still developing economies that have potential to do very well. So I think there is some untapped potential here. There is the scope to further grow and deepen access to finance that doesn't necessarily have to come from banks. And I'd also say that maybe the market is a little bit bearish about Poland at the moment. Now, I said at the start, I'm not a stock picker. That's not what we do. At Moody's, we're all about fundamental credit risk, and we use a fundamental approach like the one I showed you for sovereigns. But you can still compare what financial markets think about an issuer or a company or a bank with what we think. You can look at credit default swaps and the pricing there and see what that tells you about credit risk. You can look at bond prices, see what that tells you about credit risk. If you're really brave, you can look at equity prices and build a Merton model and see what that tells you about credit risk. And we do that actually all the time. And we do it not because market signals define our ratings, they don't, but we do want to be aware of what the market is saying to us. So what I'm showing you on this chart here is the gap or difference between what the market is saying about some of the Polish names that we rate and what we think. And all of the bars below the line are where the market is more pessimistic. The two bars above the line are where the market is more optimistic. So if you believe us, and you're willing to ignore a bit of volatility in financial markets, there's probably some unrealized value in some of these Polish names. And I have colleagues at our sister company, Moody's Analytics, that would love to talk to you about that. So please feel free to let me know, and I'll put you in touch with them. You may just be asking yourself as well, though, well, hang on, when there are these disagreements, what happens? Does Moody's move towards the market, or does the market move towards Moody's? And the good news there is it's very much the second one. Although sometimes our ratings do move towards what the market says, it's far more likely that the market moves towards us. And on a good day, I take a little bit of pride in that because I think that's the job that we're trying to do. At Moody's, we're not trying to compete with market volatility. We're not trying to compete with short-term signals. We're trying to look all the time at what the genuine signal is and strip out some of the noise. So with that, I think I will stop, and we probably have a little bit of time for questions if anybody has one. Thank you.
We have microphone.
Thank you. Thank you. That was extremely interesting. I have one question, not about the judgment that you have, but somehow if you can help me, understand. In regard to Polish rates policy,
yes,
and the differential between, or the gap between inflation. You look at United States, you have inflation of about the 6% plus, and you have the message clear that we're gonna go to 5+%. You look at South Africa, totally different sort of economy, but the GDP outlook minus plus 0. Rates, if I'm not mistaken, about 5, and inflation something like that. In Poland, you have 18, 19% inflation.
Yes.
Rate 6.75, and the message that is going to be flat. You have accumulated inflation over the last, with the end of this year, of about 3+%.
Yes.
How do you reconcile, and how you see, and I see your forecast, inflation coming down, and still, despite the fact that you have the negative real wages, but still much higher than rates. What will drive that inflation coming down, and do you really sort of feel comfortable with the MPC saying that no more rate hikes?
Thank you very much for the question. Full disclosure, I used to be a central banker at the Bank of England, so it's still difficult for me to try and criticize central banks, but I'll do my best. So there are obviously very real risks around, particularly these inflation forecasts, and the biggest one for me is that issue about what happens to wages, which I talked about at the start. But we know that in most countries, there will be some very large base effects falling out of the inflation data over the course of this year. Now, to your point, that doesn't mean that prices fall. That doesn't mean that kind of all of the run-up that we've seen in food and energy, all of that immediately reverses, because that's not a fall in inflation, that's deflation, that's falling prices. So I don't think we'll ever unwind all of that. I think there'll always be a persistent wedge in the price level between where we were and where we are. But the simple fact is, over this year, unless we get the same kind of pace of increase in food and energy and everything else that's done the work so far, inflation will fall. So I'm pretty confident that inflation at the end of this year will be lower than it is today. The problem and the question is, how does it fall after that? And there, I think, the honest answer is we don't know, but we're going to guess like everybody else. But I do think that the nature of the shock has had a different impact on inflation in Poland than in South Africa and than in the US, as you would expect. Not just because of geographical differences, but also because of the way the economy was structured in terms of its relation and use of Russian energy, for example. But also because the dynamics in the way that individual prices change over time can vary a lot even within a country, let alone between different countries. I could bore you for this on this for hours. My doctorate was on individual prices and inflation. But what I would say is 6.75 for me is a level that is actively restricting the economy and actively pushing down on inflation. So the Monetary Policy Council here could do more. You know, they could raise to 7.5 or 8 or whatever they want to do. But what matters is really that you just have some form of restrictive policy for long enough. It could be enough to sit at 6.75, which is restrictive, and stay there for much longer than financial markets expect. And that would have the same effect, potentially, as going to 8 or 9 and then cutting more quickly. Because the issue is the area, or kind of the integral between where the rate is and where that neutral rate is over time. Please. Former central banker.
Yeah. Does it matter to you if it's a longer or shorter period of coming inflation down?
For me, if I was, I'm not allowed to give policy advice, but the risk, of course, if it takes longer, is that inflation expectations become more delinked, and then you're into the kind of exactly the same kind of wage price spirals that I talked about at the start. I see a greater risk there. The flip side is, if you move too fast and get too restrictive, you can drive your economy into a big recession, potentially. And that's the balance that I think policymakers are wrestling with right now. Thank you for the question. To be fair, that's a lot to take in after a coffee break, isn't it? So I think we might be done. Thank you.